Welcome to Venija. Today we cover a crucial topic for anyone involved in international trade: letters of credit and the growing risk of sanction clauses. Hello, and thank you for joining us. We focus on making complex trade finance topics clear and easy to understand for beginners. Did you know that banks have sometimes tried to use their own internal company policies to cancel guaranteed international payments? This turns a supposedly ironclad financial promise into an uncertainty. When businesses trade globally, they rely on a letter of credit for payment assurance. However, the rising use of vague sanction clauses by cautious banks introduces massive confusion and unexpected rejection risk. This video breaks down the intersection of global trade finance and international law. You will learn what sanction clauses are, why they cause conflict, and how to protect your cross-border payments. We will cover 6 key areas in a step-by-step manner: the letter of credit, economic sanctions, the conflict with the independence principle, the ICC's stance, mandatory law, and best practices for safe navigation. Let us begin by establishing the fundamental mechanism of cross-border payment that banks sometimes try to disrupt. The core issue is that banks, fearing government fines, insert language that allows them to block payment based on mere suspicion or vague internal policies, even when a payment should be guaranteed. This creates confusion and risk for international traders, as a key financial tool becomes unreliable, impacting the trust required for global commerce. Our first topic is the safety net of global trade, the letter of credit, or LC. A letter of credit is an irrevocable, meaning uncancelable, promise from a bank to pay a seller. This promise is active, provided the seller presents specific documents proving the goods were shipped. Think of an LC as a highly secure escrow service. The bank acts as a neutral paymaster and only deals with paperwork, such as shipping receipts. If the documents strictly meet the requirements, the bank is absolutely obligated to pay. Now that we have a grasp on the LC, let us move to the element that can threaten it: economic sanctions. Economic sanctions are restrictions on trade and finance placed by governments or international bodies, like the UN or the US, against specific entities or countries. Their goal is to force a change in political behavior. Sanctions function like waging war using economic tools. If a sanction is placed on a foreign company, banks are legally forbidden from transferring funds to that company. Penalties for violations include massive fines, making banks extremely cautious. This leads us directly to the clash between bank caution and the core rule of the letter of credit. The core power of an LC relies on the independence principle. This rule states that the bank's promise to pay is completely separate from the underlying sales contract between the buyer and seller. A sanction clause is extra wording a bank adds to an LC. It claims the right to delay or refuse payment if the bank simply suspects a sanctions violation. This undermines the LC's irrevocable nature. The International Chamber of Commerce, or ICC, which sets the rules for LCs, has a clear stance on this conflict. The ICC strictly discourages banks from using broad sanction clauses, especially those based only on the bank's internal policies. Internal risk rules should not override the obligation to pay when the documents are correct. If a bank gives itself the discretion to refuse payment based on internal policies, the letter of credit becomes useless. If the bank can choose not to pay, it hasn't truly made a legally binding obligation at all. This brings us to the golden rule, which explains why sanction clauses are often unnecessary. Mandatory law always overrides private contracts. Think of legal requirements as a local speed limit that overrides a car manufacturer's claims about vehicle speed. Since economic sanctions have the strict force of law, they automatically override the LC rules. Therefore, adding a specific clause to state that the bank will obey the law is completely redundant. The best practices ensure global trade continues securely while still complying with international law. The ICC recommends that sanction clauses should not be used routinely, as they add unnecessary complication and risk to trade finance. When a clause must be used, the ICC advises it must be clear and narrowly restrictive, strictly limiting its reference to mandatory laws applicable to the bank, not vague internal policies. Thank you for watching this detailed guide on sanction clauses and letters of credit. If you have questions or want to share your experiences, please leave a comment below. If you found this video helpful, please like it and subscribe to Venetia for more direct, concise educational content.